it's very good to be here, and it's a very, very interesting topic. Just to add, what I did in the past actually has very little relevance to what I do today, which is to run a affordable housing finance company, which is actually focused on housing finance for Middle India, and we also have a subsidiary NBFC. So what I used to do in foreign banks is actually very different from what I do today. And co-origination is a very, very important opportunity for the entire NBFC HFC sector, especially for the mid-sized companies and the smaller companies. And it's nothing new actually. So when I used to work in GE, we used to have partnerships with a couple of currently very large NBFCs there today, but at that time we used to partner with them. Citibank used to do that. This is in the late 90s, in the early 2000s. It was a different model. And as Rosemary mentioned, this has been something that's been on the regulator's agenda for a long time. And that's the only way priority sector and a lot of other things can really benefit. But we firmly believed that over a period of time in the Indian market, you will have a set of institutions which are originating, risk managing, collecting, and managing a certain portfolio. You will have large banks which will be warehouses of these assets. So, and that's the way the model has historically been globally also. And there'll be a set of organizations which do resolutions and collections in other times over period. So that evolution will happen in India. So we wanted to make sure that we adopt it early. So the key things that we actually looked at was, do not worry about your core business getting cannibalized. One of the biggest worry that the NBFCs and the HFCs have is, if tomorrow the bank comes and does the same thing, what will happen? Are we going to be out of business? The Indian financial services opportunity and financial inclusion opportunity, I believe it's a multi-decade opportunity. So you will obviously find much more newer ways and more customers to do with. When we implement this, a few things are very important. One is to make sure that the data flow is largely digital and you are able to integrate APIs and do something which is through a digital pipe. The other challenge is to figure out who are your customers, which are you targeting. So for an NBFC, HFC, there would be, say, two sets of customers. One who can't come to you today because of your pricing and because they are in a different segment, and the others who already come to you, but you don't have enough liquidity or you do not want to take that whole risk on your own. So it's a model which works pretty fairly if you believe that you can originate a different set of customers which is different from you are, and you build the capability. Challenge happens when the proposal then goes to the bank after the NBFC recommends it, and they look at it completely differently. So if there are, say, a valuation report, an NBFC or a bank might look at it very, very differently. So they will say, my valuer will do this, your valuer is doing this, it's not going to work. So that clarity and consistency of what risk to buy and how to buy when there is skin in the game from a reasonably well capitalized and material institution on the other side with adequate checks and balances is a bridge that has to be the bridge of trust, as I call it, and the bridge of responsibility is something that you will need to travel. So that's a journey that you need to actually be on. The other most important thing is you got to deliver on your commitments as a financial institution or an NBFC, and which is to make sure that you originate really good quality portfolio and make sure that the partnership works. Because if the asset quality is not good enough, nobody makes money. So, and it's a very, very important thing to make sure that your collections, your asset quality, and your standards of lending are in order. So that's again a very, very important aspect of this. There will be a lot of operating issues in terms of how the accounting is done, how the GST is done, and a lot of other things which are WIP. I'm happy to answer questions. Point that I want to make is none of it is something that can't be solved. So it's about intent. It is about understanding that your company's value is not going to come down if you do not have a large balance sheet on your own book. Nothing, because if you look at some of the most valued companies in the world today, they're all marketplaces. And if you look at some of the large companies that have been valued in the financial services space internationally, they don't have large balance sheets that they own. So I think that era is getting over. And the moment people realize that and believe that they can create enough enterprise value for their own shareholders and make enough margins from this business, then I think that worry will be over and a lot more consistent intent will be there. Other thing is you have to get away from this instinct of saying that as an institution or as a bank, I'd rather do a 80-20 or a 70-30 is something that's very right thing to do. But if you also get into DSA arrangements with the NBFCs, that actually, in my view, will destroy value for both the NBFC and the bank as a whole. Because what happens is these are pretty much marketing opportunistic arrangements. So when you don't have liquidity, you want to originate for somebody else and make some fee or make some income. But the fact of the matter is, if you have skin in the game and it's a long term partnership in the way the regulations envisage it, it'll last a lot more time.